Hey folks, in this video, we're going to talk about put options or put contracts. We're going to talk about what is a put option and how you can use it in trading the stock market. Let's get into it. So what is a put option? A put option is an agreement you purchase to sell 100 shares of a stock at a particular strike price for a particular premium. So there's a buyer of the option contract and a seller of the option contract. And within the contract, someone is buying the stock and someone is selling the stock. So why do people buy put options? Well, there are a lot of reasons, but there are generally two common reasons why people buy puts. The first is because they're trying to hedge or protect an upward position or a bullish position. So let's say I've held a stock for a long time, I've collected a lot of capital gains, and I've reached a point or a resistance maybe where I'm not sure if the stock price will continue to go up. To protect myself from any losses to the shares of my stock, I can just set a price at which I want to sell that stock at some point in the future. You can do this easily with a put option. Or let's say I've held a stock position for a long time in a very volatile stock. What if I think that stock could crash 20 to 30%? Buying a put option may protect me from any serious losses. The other main reason people will trade put options is because they want to trade the put option itself in the hopes that the actual value of the contract will increase with a downturning market. So in this case, we're trading the actual premium, hoping that the premium goes up and we can sell the contract for more than we bought it for. We don't have to have an actual underlying position in the stock, such as holding shares or calls in the other direction. So similar to our other option contract, the call, what the buyer and the seller agree on in a put option contract is a strike price, an expiration date, and the price or premium the buyer of the contract accepts to initiate the trade. So let's do an example. Let's say I've held Plug Power for a long time, maybe since $5 per share. And Plug Power has exceeded $16 a share and it's continuing to go up, but maybe we're headed toward a resistance or there's some volatility in the market or market sentiment is turning from bullish to bearish. And I'm considering getting out of this position or at least protecting my position, locking in my profits and selling off my shares. So I can go to my broker, look at the options menu, and decide which put I want to buy. The things I have to consider, just like calls, you've got to consider what strike price you want. Do you want it at the money, in the money, or out of the money? Do you want a short or long-term expiration or somewhere in the middle? And how much premium are you willing to pay for that contract? So let's say I have 100 shares in Plug Power, a position that I've held since $5, and we're at $16. I've made over $1,000 and I'm not sure if it's going to reach $17. I can buy this put option here at $16 strike price for $84. So remember that says 84 cents per share times 100 shares in each put contract. So that's $84 of premium. And I'm agreeing to sell Plug Power at some point in the future, in this case, in about a week for $16 a share. I'm buying this put option to reserve the right to do that. So you might ask, why would I pay to lock in a price that I can sell at? Well, there's a lot of evidence that the stock market moves down a lot more rapidly or with a lot more volatility than it moves upward. Moves downward tend to happen a lot more sharply. Moves upward tend to happen a little bit more gradually. So let's say market sentiment is turning bearish, economic conditions don't look good, or let's say Plug Power is expected to produce weak earnings. Plug Power may drop down dramatically in a short amount of time. With the put contract, you lock in a price that you can sell at. So let's say I bought a put option at a $16 a share strike price and Plug Power gaps down to $12 the next day. A pretty rapid move, right? Well, I've locked in $16 as my selling price, just paying $84. So instead of maybe losing $400, I might only lose $100 on that, plus the $84 I paid in premium. Or let's just say I want to trade the stock's put option and I buy the $16 strike price put option at $84 and the market gaps down to $12. It's now a lot more valuable to buy those or to sell those shares at $16 a share than $12 a share. And therefore the value of the actual contract goes up from maybe $84 to $200, $300, whatever it may be. So I can sell that increased value put option when I only bought it for $84, and I can collect profit that way as well. So you can make money without an underlying position. So if I'm the buyer of the put option, let's look at what we've got to consider. Well, for one, I want to be right because I'm paying to be right. Another thing is I especially don't want to overpay for my premium with puts because, again, a downtrending market moves with a lot more pace or a lot more rapidly, and therefore volatility is high. And if you remember from options valuations, increased volatility makes the premium of the option more expensive. So I'd have to pay more to lock in my put contract if I'm the buyer. I want to get out of the trade soon if it doesn't go my way. This is especially true for shorter term put options because value of an options contract goes down more dramatically the closer to expiration we are. That's what we call time decay of an option contract. I've got to decide if I want to be in this trade long term or short term as well. If I just want to protect myself or trade put options during an earnings call, I may only keep that contract for a day or two. If I'm sensing that the market is getting shaky, more volatile, or if it may experience a drawback at some point in the future, but I'm not entirely sure exactly when, I can get a medium or long-term put. Similarly, if I expect that a company might be faltering or it's experiencing volatility or buyers are losing confidence, I might get a medium or longer term put so that I have more time insurance to make sure that trade goes in the right direction. Then I've got to consider what amount of risk I'm willing to take on. Am I willing to pay a heavy premium for a put option? Am I willing to pay more in the money, more out of the money? Am I going to get out of this position shortly, or am I going to average into it for a longer term play? I've got to decide what amount of risk and at what point I'm going to cut my losses or how long I'm going to stay in the trade. So how is the premium calculated on a put option contract? Pretty much the same way as a call option contract. It uses the Black-Scholes model. And remember, that takes into consideration the strike price of an option, the current stock price, the distance between those two things, the time to expiration, the interest rate or the federal funds rate, and then the volatility of the overall market and the volatility of the individual stock you're trading. The Black-Scholes model is a little bit complicated, but these are the main components that influence the value of that put option premium or the value of that put option contract. So when we're looking at strike price, we want to decide, do we want to at the money put, in the money put, or out of the money put? So let's review what each of those is and then when it's appropriate to buy those particular put options. So an at the money put option has the closest strike price available for sale from the current market price. So the strike price is either slightly above or slightly below the actual market price of that stock. I tend to trade at the money put options when I've held a position for a long time. I plan to exit that position and I want to lock in my profits or capital gains from holding that stock. The premium of an at the money put option is between in the money and out of the money, and it's cheap enough or reasonable enough to warrant buying insurance to protect against any rapid fall in the stock price. So for an in the money put option, the strike price is on the other side of your trade. So if you're bearish, the strike price is above the current price. So you're agreeing to sell at a strike price that's above the current market price. So therefore, in the money put options have higher premiums because it's a good deal for the person buying it, and the seller has to get compensated somehow, so the premium tends to be noticeably higher. I don't often buy in the money put options, but when I do, it's because I've done extensive due diligence, I've studied the market, done my research, done my fundamental analysis, and I have a pretty good idea that the particular stock I'm trading is going to move down at some point in the future. With in the money put options, I tend to pick at least a medium term expiration date, meaning anywhere from 4 to 6 months all the way to a year out, and maybe even in rare cases 2 years out, because that gives me a lot more time insurance. It also allows me to average down. What do I mean? Well, let's say the price of the stock continues to go upward. The value of your put option would decrease because it's losing some of its extrinsic value. Basically speaking, it's making less sense to buy that put option for the reasons we've talked about. Put options increase in value when the stock price goes down. They decrease in value when the stock price goes up. Because why would you agree to sell a stock at a low strike price if the market is going to continue to go up. So if the market moves upward and I'm in a put option, the value of that put becomes cheaper. That means I can buy more of those contracts and lower my cost basis for the puts. So let's say the price of the stock continues to move up and my put option becomes cheaper. I can now buy more of the same put option with the same expiration date and the same strike price for a lot cheaper. The value of the contract becomes cheaper. So I could buy several more contracts and lower my cost basis for the put. When the market does finally move downward, those cheaper contracts become more valuable and I can sell them for a profit. With out-of-the-money put options, a strike price is far from the current price but in the same direction of the trade. So if you're bearish, the strike price is then below the current price. Out-of-the-money put options tend to be a little cheaper. Why? Well, if you're the buyer of the put option, you're already paying a premium to sell your shares. And then if you pick a lower strike price, you're getting less money for your shares. So the options council or committee that sets the value of these put options makes out-of-the-money contracts a little bit cheaper. If you're agreeing to sell your shares and you're accepting a lower strike price, you're basically accepting less money for your share, and therefore they make the premium a little bit more affordable. I tend to use out-of-the-money put options for sort of speculative or gamble trades, maybe on earnings, or maybe if I feel like the market is going to go through a significant downturn due to some kind of economic news. For example, I tend to use out-of-the-money put options on more risk-on speculative or what we call gamble trades that are cheap, but they stand to make a lot of money. You might not have a high win percentage of these, but you only need a couple trades to make a lot of money. For example, if I think the market's going to move down sharply or there's going to be a ton of volatility coming up, maybe in a week or so, I may buy a way out of the money put option with a relatively short expiration date that has a very cheap premium. Because in the event that that market does move rapidly in the downward direction or that stock moves rapidly downward, I stand to make a lot of money because the value of the put option contract will get increasingly more valuable the faster it moves. So this is one of those scenarios where you can put in a little bit of money and stand to make a lot of money if you can accept the increased risk, meaning the fact that the market might not move as quickly as you think. This strategy I do use more rarely, but it's good for earnings that you think will bomb or for dramatic economic news that can shake up the market significantly. So, which type of contract should you pick? Well, it depends on what you're trying to do. Are you short-term, long-term? Are you playing it risky or not risky? You've really got to decide why you're going into this trade. If you think this market move is going to take a lot of time, you want to give yourself plenty of time for your expiration date, and then you might want to pick an at-the-money or in-the-money contract so it has lots of intrinsic value and doesn't suffer as much from time decay. If you think this is one of those market events that could happen suddenly, or the market's extremely volatile, or an earnings report might bomb, you might play it more short-term and you might pick an out-of-the-money option so that you can save money on premium. There are dozens of scenarios in the market. You've got to decide if a put option is appropriate for this scenario and then which type of put option is appropriate for that scenario. Other considerations for buying a put option, well, we just talked about it. Make yourself a good trading plan first and decide if the put option is appropriate according to your trading plan. Determine the level of risk you're willing to take on, and then gauge how sure you are that there could be a pullback in the market. Maybe you're bored and you're trying to impulsively trade. Maybe you're just paranoid, or maybe you're being plain greedy. Maybe you're overconfident, or maybe your emotions are in the way. Make sure you're doing your due diligence and your fundamental analysis to determine that this is the appropriate type of trade you should be in. And then which type of contract should you pick based on strike price, volatility, days until expiration, and all the factors that go into the option's valuation. You want to make sure the put option that you choose for yourself is most appropriate for this scenario and for your trading plan. So good luck beginning options trading. Now you know something about put options. My recommendation is to start slowly and start correctly. If you feel like there's more knowledge you could gather about put options, go read up on that first and then get to trading. I wish you the best on your trading journey. I'll see you in the markets.